There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
So let's take a quick look at this week. I've been out on vacation, as many of you may have seen some of my posts on the Telegram channel. So thanks for the patience there. We really didn't have much of an opportunity or any coverage being out on the ocean there. So we will let this broadcast serve as sort of a catch-up for the last week. But today being Tuesday, we had really nothing going on yesterday. But, you know, honestly, it really doesn't matter. I mean, it's going to be very interesting, obviously, on the 15th, which is tomorrow, of what the Federal Reserve says. I mean, a lot of this is just totally getting priced into the market. I mean, I think the real concern is that you know, the ECB and certainly the IMF and a bunch of European organizations have come out and said that, hey, you know, we're going to start raising rates. And I think that came as a surprise to the market. We've had a huge sell-off in equities. So whether it's Armageddon or if this is another head fake by the market, remember I talk a lot about that concept of Max Payne trying to suck in most of the investors before the rug essentially just gets pulled out from underneath you. You really want to pay attention to, you know, how that all plays out, right? So let me just switch out of this, and you know, it's the interesting thing is I don't see this right here on Friday on the 17th, showing the ForexFactory.com. Actually, filter out. Just you want to keep the red events essentially. So looks like the inaugural conference on the international roles of the U.S. dollar. So, Chairman Powell has been quite reserved in his comments, right? So a lot of the comments, and you know, he's been quite poised, as most Fed and international central bankers are. I mean, occasionally you'll catch him on a hot mic making some comment and markets go wild, but for the most part, I mean, these guys spend an inordinate amount of time putting together a plan and not trying to sort of give away any secrets to what they're going to do to the marketplace, right? But you always have to be on your toes at these events, and this event's actually brand new. So this is an inaugural event, so just keep a note on that Friday morning in case any crazy comments come out. This being the most important thing, you know, the craziness about there's always something to be loony about in any of these marketplaces, right? But the thing I always get the biggest kick out of in most of these really volatile periods of time is that it brings all of the BS prognosticators out of the woodwork, for lack of a better term, and they go off on these tangents and rants, and newsletter subscriptions go up, and you know, all of the lunacy sort of ensues in the marketplace, and I would challenge everybody out there in AP subland, don't get caught up in that stuff. I mean, I tell clients the same thing. Most of our clients are comfortable with what their allocations are, and if they aren't, and we've done a poor job, which is very rare, we'll make changes to that, right? But if you are comfortable during this big decline, that means that you've put risk control in place and you've changed the allocations to maybe something more conservative, especially if you don't have a large time or a long time frame, I should say, for the money, right? I always get questions on, hey, I get this client that wants to do this, and this potential wants to do that from an advisor. The first question always is for me, what does the client's portfolio look like? What are the allocations? What's in real estate? What's in cash, right? What's in stocks, bonds, currencies, any kind of commodities or a business, right? What are they invested in hedge funds or something more esoteric like venture cap or private equity, right? So you want to know what the portfolio generally looks like before you can get into making any recommendations. So I would ask you guys to approach that from the same perspective as you would a financial advisor. You always want to look at the whole pie. I think a problem with a lot of the risk management I see, at least in terms of just overall wealth management, asset management, is that people tend to put things into a box. They compartmentalize stuff and saying, well, that's my safe money and then this is my risk money. That's okay to do that, but the vast majority of them do not have an overall understanding of what their pie looks like, so to speak, right? What's the sliver in equities or currencies, if any, right? What are the slivers in annuities or bonds or more of the safe type of products, or the real risky stuff like commodities or something in a tech only triple leveraged hedge fund or ETF, right? So those are always the things you want to be cognizant of, and just the overall makeup. A client that will complain to you, or a particular investor or trader will say, well, I had money in XYZ and I lost a bunch of money. And, you have to sort of drill down and do this in your own head as an exercise as to, what was the loss in relation to the overall portfolio, right? If it's 1 to 2 or 3% in some cases of the portfolio, maybe a particular investment in some sort of crypto, which is absolutely cratering, I'll take a victory lap for that, obviously. But the concern in your mind as far as risk management of the portfolio should be, what is the overall percentage risk that it represents to my whole portfolio, right? If it's 1 to 2 or 3%, I always say let your heart not be troubled with that, right? If it's something that's higher, then you more than likely have taken too much risk with that particular asset class, right? We have a lot of quietness in social media these days among all the starry-eyed and laser-eyed people and crypto this and that. Why? Because a lot of them are probably just getting clobbered right now. They can't handle it. So people have a tendency to clam up and go dark. Ideally, if that is in fact what's happening, your best bet, keep that inner monkey sort of calm and uncrazy, is to talk about your mistakes, right? A lot of people don't do that. You always hear the one gambling friend that says, I won all kinds of money in Vegas or some casino around the world, right? And I always ask, hey, that's great. What are your losses in relation to your wins? Oh, and I don't calculate that. And I say, well, that's fine, but it's wrong. You're not exercising proper risk management. Most of my friends don't want to hear that, right? So they don't tell me about their wins or losses at casinos, because I'll just drill down, and the vast majority of the cases, they've ended up losing more money than they've ever won. Sports books, the ponies, all this stuff, right? So, and I probably seem to talk too much about this, but I think that many traders don't understand what the racetrack looks like. There's my F1 analogy of the week. Don't understand what the racetrack looks like, and they're more interested just in getting in the car and ripping around at, make up the speed, 200 miles an hour around the track. They don't understand turn 1, turn 2, and 3, and they'll wind up, dying in turn 3. Blows up their whole portfolio. The car explodes, right? Fiery ball crash. I say, look at the track, study other tracks, study the cars, study your competition's cars, right? Know your team, know the computer systems, know the tires, know the engine, right? I know this maybe just sounds a bit much, but it really does come back to that. Most investors out there, vast majority of the ones we deal with at this firm, these people have no idea what they're invested in, why, how, where, right? You always have the people that'll say, well, I'm getting great income off my portfolio, right? But then when you drill down a little further and you're learning that, they have 3 or 4 pieces of real estate that's absolutely just clobbered them in price from where they pay it. You might be getting great income, but if the asset itself's getting just clobbered, right, then it's not a good investment. I don't give a shit if it's an equity, a bond, an investment, anything in crypto, or certainly the options and currency space, which we spend most of our time on as a company. So that would be my crazy rant for the day. But let me just jump back here to Forex Factory count. So keep an eye on. Obviously, this is 2 p.m. Eastern time here, so my time will be a little different than yours. But you can always sync these times up here, or just hit an F5 and refresh the screen. But with a lot of this right here, there's lots of stuff, there's lots of noise, but all we really care about is what are the central banks doing and what does inflation look like? And what are policymakers or the Fed or any central bank doing to curtail it, right? Everybody say, well, they need to raise rates, right? And, well, I mean, not necessarily, because that can kill an already tepid recovery, right? What they need to do is push down demand. That's the key. So there's multiple ways to push down demand that don't necessarily have to come from raising prices. And I'm not going to get into a lot of that because we're going a little deeper in the macro than we probably need to for this discussion. So let's just take a look at the all charts here. I want to look at the daily. Obviously we know the wreck's going on in equities. At some point this area is going to become a buy. Can't say that it is right now because we're setting lower lows on almost every index, on almost every broad indice around the world. So stay tuned on that. If you're looking to sift through the ashes, we'll be doing that soon. Soon could be the end of the year, by the way, too. So it just depends on one's definition of soon. The canary in the coal mine is we're already starting to see some cracks in gas, not necessarily heating oil, but these markets have been really manipulated recently. So I would say don't pay too much attention to these. Gas, a little bit of a reprieve, but this chart's been much uglier than these. But nat gas is absolutely cratered. So things are starting to come down. The gold space, this is the thing that's always perplexing to me of current times. Things were really truly that bad. And as I posted on Telegram, if you extrapolate out all of the energy and its effect across what I like to call pin actions in multiple industries, if you were actually to take that out of the equation, inflation's actually not that bad. Isn't that crazy? So, and maybe it's the gold really is telling the story, because if this really was that serious of a time, the price of this asset would be right up around 2,000 or higher. So I've been saying for like a year. So maybe this is just like, hey, it's no more of a tell, and you always hear the comments, it's different this time, right? And realistically, it's never different, right? And this is a phrase I take directly from one of my big mentors, Ken Fisher, extraordinaire, written many books, was the portfolio strategist in Forbes magazine for almost 30 years. He said it rarely ever is different. It just feels different, okay? So don't let any pundit try and sell you some subscription, or somebody run you amok with some sort of recommendation to invest in this or that because it's different this time. It rarely ever is, okay? It just feels different. So that is my advice for the day. That is our discussion of metals. I'm not going to get too much into copper. I always say keep an eye on this right here. Interesting. If things were absolutely on fire in housing land, what would the price of lumber be? Actually, let me jump back to a weekly chart on this. How would the price of the lumber be back to where it was? This is almost like the leveling area here, right in this 400 to 500 range. If things were really truly that crazy, wouldn't it be up around 1,400? Just saying. What else? So this has been the concern of the marketplace. So keep in mind, 10-year notes are tied to the 30-year forward fixed rate mortgage market, 5-year ARM, so forth. But for the most part, you have an amalgamation of these three that form mortgage rates, which are paid attention to much, much more than any of the price of these bonds. But very simply, as the price of bonds go down, the yields go up. So this is the reason that the bonds are cratered, But if you take a look at just the 10-year, it looks ugly, right? But what if we look at the weekly chart? We're back to where we were just in 19 in terms of price. This was the risk on in terms of risk off in other asset classes, but this was the risk on chart. We're only back to where we were in terms of price here, right? The fact that we've moved this quickly in tens is a reason for more pundits to come out of the woodwork and pitch their wares, right? And I usually tell everybody, if you're going to subscribe to a newsletter, there's only 2 that I recommend out there, which is an exceptionally small list of newsletters are out there. I subscribe to these 2. These 2 are some of the best worldly thinkers out there, and they completely disagree with the current mania that's going on, although they're not predicting any rosiness either. They just want people to see through the mud, which is where we're viewing most of the global macro here, not through the optics of any clarity, but we're trying to look through a big thing of mud. It's crazy. So you sort of have to make your way through it. In any case, if you take a look at a monthly chart on this, you can kind of see where we were as far as long term, right? We had rates and mortgages, and the first mortgage I ever took out on a house was right here in 2000, and it was 6.25%, right? And I thought I was getting a raging deal when we bought our big house in 03, right? And rates had, marketed in terms of rates had gone up. Fed was tightening, not very much, but the real QT started right here. This is when the Fed went on an unprecedented ride of a long period of time of quantitative tightening, or quantitative easing, where essentially they're pulling assets off the marketplace and putting cash in primary dealers' accounts. So, I would say just understanding what's going on. Yes, it's a huge drop, but it shouldn't be a surprise that all of the opium, or whatever analogy you want to use of the drug, if you will, that this marketplaces have been on Fed-induced drug binges is coming to a halt. And we're getting to see where assets can really stand on their own 2 feet. Many of them aren't standing very well. So as I had mentioned, if this does take place, we're probably going to see an absolute clobbering in anything that is what I like to call secondary investment, right? Art, classic cars. I'm talking about general artwork, not the really rare stuff you see on TV, but classic cars, crypto, a second or a third house. These are the areas that are going to get absolutely slaughtered if we get much more down, right? They pull those assets typically first. All right. So enough, it seems like I talk about the credit markets too much, but these really have been the pin action from almost everything that's going on. So why is the U.S. dollar rallying the bunch it has? Well, look what's going on in bonds, right? You're seeing flights to safety here and flights out of almost everything else, right? Typically, not to say that we're that much better of a country with all the debt we have, but it's always an example of the lesser of 2 evils. The only thing that's rallying on this chart is the U.S. dollar, and really, really highly manipulated commodities like oil and Brent, right? But if you look across a lot of this, much of the other metals, forget about maybe those, but much of the commodities, and we're looking again on, let's just focus on weekly charts. U.S. dollar's been going up, again, weekly charts. Almost every other currency's been going down. Bonds have been going down. And a lot of commodities, with the exception of OJ, they're not near the highs, right? Certainly energy is, which spins out into almost everything in that pin action, but a lot of commodities just are in the toilet like lumber. That's actually surprising, right? Oh, housing market's great, and here's that risk management thing again, right? Listening to the realtors, oh yeah, the market's great, it's going to be going up. Well, I don't care how great the market is. When the marketplace was able to get mortgages for 3% and now they're paying close to 6%, they're not going to want to buy a house. And the ones that are under grand illusions that they'll be able to refinance back down to 3 again, don't think it's going to happen. Just my opinion. A lot of the realtors out there probably don't like most of my podcasts that we do because we're usually just slamming them as a group. And the reality is that it is a very one-sided, very overly biased, one of the largest in the country as a lobbying group, right? So I always tell people you want to pay attention to the Jeffrey Gunlocks of the world and guys that have nothing to do with income and real estate, even though they may own a REIT fund, right? But they want to give an honest opinion of the marketplace, and the more levered that real estate fund is, the more risky it is at this current time, right? And that's sort of my last risk management note. I came across a client that has a number of what's called Reg D investments, meaning that these are unregulated, they're not publicly traded investments. It can be in everything from, restaurants to Joe the Boxer to, in this case, a bunch of private real estate, where you have to be a accredited investor, very essentially high net worth, even to get in the door, and you have a lack of liquidity and very unflexible options as far as getting liquidity out of it. They have the ability to lock up the investment, as we've certainly seen. And this particular investment's been locked up. It's taken us almost 3 months of liquidation requests via some old-ass and archaic forms mailed through the Postal Service to get these liquidations done out of a very large real estate investment trust. The company's called Blue Rock. And it's just completely pissed me off because I can't get any color from these guys on what the leverage looks like in the portfolio. I have a feeling it's high. So the price has been coming down and they just stopped providing liquidity, right? It's the biggest problem I see with some of these investments. And, the same thing could be said. I had a client who had something similar to this as a private Reg D investment in a couple Outback steakhouses in Philadelphia, right? So all I'm saying is, it's great to be diversified and all this stuff, but know what you're getting into from a risk standpoint, obviously. Know how it fits into the portfolio as far as diversification or not. For gosh sakes, have an understanding of the lockups that may be associated with some of this long-term stuff. All right, let's get off the soapbox here and talk about currencies. Okay, let's go in, take a look at the dollar first. So, sticking to just high-level themes for the discussion today. DXY, right back up to the high. Concerns of interest rate increases. Where does the money typically roar to? The lesser of all evils, which right now is the U.S. dollar. So it is the safe haven asset that dollars are flocking to, and we've made new highs. And we're going, in which case we're going to go all the way to a monthly chart on this. If we go all the way back, last time we were this high, just under 105 and a half, it's 2002. So we haven't seen this level before, right? Many portfolio managers didn't run money back in 2002. Essentially, it was almost a perfect 20 years ago that we saw this price before. So, they may be concerned. They may say, hey, it's, this is some of the reasons that it is different this time, and it really isn't. We just haven't seen a period of time where two of the biggest central banks on the planet have completely shifted focus from one monetary policy from QE to QT, right? And how do we deal with that? You deal with that by lightening up on risk assets and not being leveraged, right? Not betting too much on the downside or upside, but if you could bet on volatility, that's where it certainly has. So let's take a look at the VIX index, and I haven't shown that in a while. We're certainly keeping an eye on the VIX. We've had, and this is a monthly chart, so let's just go to weekly, but had a couple of stabs. Recently at some higher volatility, but in my opinion, unless you're seeing some of these Armageddon readings above 70 and 60, this whole area, the correction is not over. It's almost like we need a crescendo event, throw out the baby with the bathwater, everybody hits the sell button, everything's off, and then we begin to retrace and form whatever sideways trading that we're going to need to trade in these markets, because we need it. There's too much uncertainty out there. It seems to me like the smart monies had sold off in that last rally in equities, and now they're positioning for a more significant decline, right? But and this is the NASDAQ market here over a weekly chart as well, so you can see the highs in NASDAQ. I know some of you guys trade these indices on MT4, which is right around 16,000. We've already lost almost 6,000. So there has been a significant correction in the NASDAQ, and we just hit today the big dog. This is the 200-day line. See this red line right here? I'm going to just light it up. Big bounce. We should see a bounce off this line. Whereas if you look at the just S&P, still got a ways to go to get to that 200 line. This is usually where the final pukage, if you will, of long-term holders. We'll see if that even transpires, if we can actually close underneath these big levels. So I would say stick to the bigger picture. It looks to me like the magnet is somewhere in this area for a bounce, but who knows? What if the Federal Reserve does some sort of about face and finds some way to communicate to the marketplace that, hey, they're not raising interest rates anymore, they're going to use other means to squell demand in any of the markets. I think we'd see a big rally. I think there'd be a true face ripper because there's just a lot of people getting fat on these big shorts that have been paying off nice, where I think you could be quite late to the game on that. So if you're trading this stuff on a shorter time frame, certainly I would imagine it's day or even 30-minute charts for some of the software. You can do 15. Just know that we're over. So there's the 15. Let me reset this. There's a 31 hour. You notice I'm just focusing on these Bollinger Bands of whatever standard deviation now we are. Right? It's 4 day. Look at the day. We're right there. When have we been in an expanded part of the bands too, right? When have we been touching this low end Bollinger Band over the last number of period of time? What has led to every time we touched it? Pretty decent rally. We had a huge one here, and this was really when the Fed was like, hey, it's time to start tightening. And the market had caught a whiff of that, and that's why we were headed down before, but they see it when we rallied out. So could be due for a quick relief rally, dead cat bounce, whatever you want to call it. Hell, I could be wrong, but just telling you what I see in the charts as far as anybody trading the S&P or Qs. We're there. And that's a weekly chart. Let's just take a look at the daily. And then we're way under that 200-day on the daily. No surprise, but the weekly's a big one. This is a big area right here. You can also see that right at this, and this is the Qs, and you can use the index as a whole, but I like the Qs because this is just a ridiculously hugely traded index, so it shows a lot of all of the profiles on the side, and as the different profiles sort of play shape. What you can see in here is that there's some missing notches in there, right around this 250 area. So that would correspond to the 200, almost like a zone, if you will. Almost like you could get down and fill that auction and possibly reverse back up. Just saying, could be wrong. DXY, here we are, no man's land. I would say it's time to digest these moves again and maybe continue just to trade inside these range would be my guess. I've tried to stay away from guesses because, I've generally been right, but you know, the area where I certainly could have a much higher percentage of being wrong is calling this stuff on a 5 or a 10 or a 30-minute chart, right? I always get questions on what chart times I look at. I look at the 30-minute just because the market profile is built in 30-minute segments as far as just the broad indexes, but you apply the same type of analysis to that. The difference of the currency markets is that your best times with this is the overlap of the close of the European session across about 3 or 4 hours of the open of US, right? Then after that, it kind of goes dead, usually. Less liquid can be also more manipulated. Remember that from a risk standpoint too. So again, got to be on weekly charts in this stuff. Just a ridiculous drop in the pound. And this is a big move for a weekly chart. You know, and we're on Tuesday. So Tuesday with, 3 other days to trade after today finishes out. But we're right at a support point. I should take that back. We sort of crashed through it. Let's see. First time we've been here in a while. Again, weekly charts. Top of this range in US dollar, Canadian dollar, USD JPY. I mean, just falling off the cliff is the price of the yen. I don't even know if, nothing's going to register here on a monthly chart. Look at that. It's the last time this took place. So here you go. There's probably some crazy coming out of the woodwork on this one. The last time the yen has had this low of a point in relation to the US dollar was approximately the September region of 1998, right? So they probably can show some crazies out to try and sell newsletters on this one. That is amazing. It's almost like tonight would be just a fantastic time to be in the import-export business with on both sides of the coin, right? From a U.S. company selling in Japan to a Japanese company selling here, or an individual importing or exporting from either area. Love or not. Let's see what else. Let's take a look at my favorite asset class out of every of these, because it's just so easy to foretell the lunacy that is going on in here. So, had a bunch of people, a couple of employees in the office, like, hey, crypto's cheap, let's go in and start buying. I'm like, I wouldn't do any of that purchasing right now. I'll let this play itself out. Probably got a lot more pain to go through. A lot more noise here, but if we go on the daily chart, the pain is now defined here. There we go. So when we see a quick, whatever group of whales liquidated, now you get to see where the market really stands on its own feet. Going back all the way, and this is really noisy, so let's just go to a weekly. Clean it up. So what happened? Yeah, okay, so the previous all-time high that was the first high was right here on December 17th. Right in this area. And a little bit more down to go. Wouldn't be surprised to see a bounce in this area. This is also a couple of handle breakout area. So it wouldn't make any surprise to learn that the auctioning process will oftentimes bring all assets back down to and truly test where they broke out from a particular region, right? Calling it, maybe there was some unfinished auctions down here, not necessarily as much of this, but this applies a lot more if you're trading like the ESD mini S&P 500. If there was a whole bunch of finished or missing notches in volume profiles down here, you almost always will have an auctioning back down to that point. The difference is we cannot foretell the time or the place that it will happen, right? If we could, we'd be laying on the beach somewhere with a bunch of jets. So, what else can we surmise? Here is a Ethereum chart which suffered the same type of pain. BITO. I don't know why I have this on there anymore. Let me just take this off. Can't be long this here. Should probably take ARC off too. Well, wasn't this a disaster du jour story, huh? If you're not sure who ARC Innovation is, you can look it up. Person that runs this company is in her 60s, and she's been was risen to superstar among many of the groups that invest, especially millennials, and they chased her performance. And what they don't realize is she was just overweighted in like 5 or 6 tech stocks, including Nvidia and Tesla, on this ride out. It's just absolute clout. Imagine if you bought into this mutual fund in this mania. Maybe you didn't catch the top. Maybe you bought it around your 132. You're like, yeah, it's going to 300. Now your 132's been cut into a quarter, right? Not going to make you feel so good. Do you still hold? There's been, I wouldn't be surprised if there was some sort of spectacular blow up of this fund company. Wouldn't be surprised. Alright. Let's spend too much time here. SDS is the ultra short S&P 500. It's the inverse of the long, which is the SSO. So this is double long, double short. For the question I got on this, I forgot to answer last. They're just pro shares. They're been around for quite a while. Family runs some levered ETFs. Take a look at GBP CAD. Jumping back to currency land. This is just, it's the boom of the British pound down, strength of Canadian, obviously US as well. Euro GBP. So the strength of the euro because of the weakness in the pound. There are obviously a variety of factors that enter into this. Brexit, the fact that ECB is going to start raising interest rates, that caught the market by surprise. There's a bunch of other news stories that are broke, but I'm trying to pay attention to just the big macro stuff and not get too into the weeds on this, because doing a bunch of tearing apart analysis is really not doing any of us any good right now when we have such a fluid situation as far as central banks' money supply, international geo events like what's going on in Ukraine, juxtapositioning between China and what's going on with their markets with lockdowns, and then their potential to go on into Taiwan. It's really a fairly unsettled period of time. It makes you wish you had, again, some of those top leaders that used to run different countries before the crazies were voted in. So let's take a look at gold here. I'm going to look at the spot price of gold as well. So we are 2000's the high, capped off essentially the top of this move. Bottom of this move is somewhere in the area of 1800. No, I'm sorry, 1750. Let's focus on that. So let's take a look at it as well.
My assumption is end result. What do you want to get? So I have a 20% loan product, and I do that, and he's within that 6 to 11%, and we have a year time.
Emerging markets. Yeah, I think that's pretty much everyone we wanted to cover. Take a look at my Telegram channel if you're new to this whole gig. I try to do this Tuesdays and Saturdays as best I can around 1 p.m. to 10 a.m. Eastern time on Saturday. I will be back on the mic on Saturday giving a roundup of what's going on, just going through an overview, trying to keep it really simple and big level, because there could be some more dangerous stuff. I think the market's digesting some crazy moves in almost every area. So I will wish everybody, and you can always ask me questions on Telegram too, or spread the word that these channels, hopefully provide some valuable feedback. But always looking for comments, so feel free to drop me a line. Everybody have a great week, and may the trades be with you.